What's up, guys? Today we're going to be taking a closer look at Nautilus. Nautilus did appear in Joel Greenblatt's famous Magic Formula screener and has been on the screener for quite some time. And since I first looked at it, or since I first saw it on the screener in January, the price has dropped quite a bit. So I thought it's a great time to really analyze what this company is doing. So let's begin. Nautilus is a household name in the home fitness equipment. They sell treadmills, bikes, ellipticals, other cardio machines, and strength equipment. Maybe you've not heard of Nautilus. You may have heard about some of the companies they own. So, for example, Bowflex, Schwinn, JRNY. Let's begin. So, how does Nautilus get its revenue? So we've already talked. They already sell these home fitness equipment, but in terms of how they divide their revenue, they divide it in two ways. So the first way to divide it is between their retail sales and their direct sales. So retail sales consist of Nautilus selling its equipment to brick and mortar store locations. For example, Dick's Sporting Goods. The primary brands Nautilus sells to retail stores are Bowflex and Schwinn. Direct sales consists of Nautilus directly selling to consumer, usually through the websites of the different brands they own, and they sell all of their products directly to consumers. Additionally, we even need to take a look at the range of products Nautilus sells. So Nautilus does have quite a few products, but they separate it into strength products and cardio products. Cardio products make up around 75% of their revenue, while strength products make up around 25% of their revenue. So they're primarily focused on getting their cardio products out to customers. Okay, before we can go any further, it is very important to take a look at the history of Nautilus. So let's take a trip down memory lane in 2017. So up to 2017, Nautilus was a very strong company. They had their revenue grow at around 16.82% compound annually since 2012. There were some signs of trouble in 2017 that, upon reading the 10K report, you could have seen. For example, they did have an asset impairment charge of 8.8 million due to the overvaluation of their Octane Fitness brand by management. So, an asset impairment charge occurs when the market value of a company's asset decreases below its book value, and it was recorded on their income statement. So basically what happened was management overvalued their Octane Fitness brand by quite a bit. And by the way, what I mean by overvalued, they overvalued the goodwill of their Octane Fitness brand by quite a bit, and it showed up as a charge on their income statement. Another signs of worry were that they were getting decreased demand for their tread climber. Okay, let's go to 2018. So 2018 is when problems really begin arising. They have a decrease of $9.3 million from their revenue due to the decreased demand for the Bowflex Max Trainer. Additionally, the tread climber still was not doing very good this year either and had not recovered since last year. The earnings per share went all the way from 89 cents per share down to 59 cents per share. So the company really began seeing some hardships. There were some positive. The biggest positive was the acquisition of PowFit Holdings Limited. PowFit Holdings Limited has digital platforms such as, I believe, Run Social and Ride Social. So by acquiring PowFit Limited, they were able to expose themselves into the digital connected fitness realm, which we will about to see is very important for Nautilus to keep up to its competitors. Okay, let's keep going on to 2019. Now we have some big problems. I'm going to show you the numbers in a second, but it didn't fit well into one slide. So let me just talk about it first. So first thing is, they have a $72 million asset impairment charge, again, due to, overvaluing Octane Fitness brand. So this was really management screwing up here with this Octane Fitness brand. Another problem was that their net sales plummeted due to very low demand for the Bowflex Max Trainer and even other products. Just the Bowflex Max Trainer stuck out the most. Their stock price dropped all the way down to below $2 per share. The only good that could be seen in 2019 was their JRNY digital platform begins emerging, and it begins emerging through the PowFit Holdings Limited. So let's start talking about the JRNY digital platform. So it basically is a platform similar to like what Peloton has, where it coaches members. So you have a screen in front of you. It could be your screen, but if you buy some of their products, they will provide you a screen. But basically, it coaches you through specialized machine learning algorithms to curate specialized workouts for each individual client. So this is very similar to what other companies are doing. It's just Nautilus was a little far behind in actually developing this technology, but they finally began developing this technology in 2019. One major way it helps, especially in this revenue, is that it is subscription based. So we will be getting recurring revenue streams when members sign on to the JRNY platform. And here to look at the numbers. So yeah, net sales all the way down $87 million. That asset impairment charge of $72 million. So that's really management screwing up. That's really inexcusable on part from management. And we can see that net income now is at negative numbers, which terrible. Okay, 2020. 2020 is when things start picking up. We get massive COVID-19 tailwinds. People cannot go to gyms anymore, so they're buying exercise equipment at home. I remember when COVID first began, I got a pull-up bar like in 2012 for around like $10 to $15, and I looked up that same pull-up bar on Amazon was going for around $60, which was absolutely incredible to me. But yeah, people began buying home exercise equipment since they could not go out and exercise in gyms. In July of 2019, Nautilus did get a new CEO called Jim Barr. Jim Barr did not come from inside the company; he came from outside the company, but he did have a high background in digital connective transformation. So, for example, at Office Max, where he worked before, he transformed the online business from declining revenues to double-digit growth. So, Nautilus was really hoping that he could do something for them, which so far he has, but again, we're going to get into it. It's kind of hard to tell how much of this will stay now that COVID is almost over. So, yeah, the 2020 numbers really speak for themselves. Revenue grows by $243 million. Net income goes from being negative 92 million all the way up to almost 60 million. So, definitely getting some positive tailwinds here. Again, JRNY, really important. According to the annual 10Ks, there was a lot of positive customer responses new platform. Unfortunately, Nautilus does not publish, or at least I could not find anywhere in their annual reports, how much of their revenue actually came from the subscription of the JRNY platform. I hoped eventually they do show this information or make it a little more clear. But Nautilus really does want to get a larger and larger revenue base, so they do have that recurring revenue stream. Peloton, I believe, on their platform, they have 20% of their revenue being recurring from their digital platform. So, yeah, Nautilus definitely trying to focus on that. And now the question comes, can management keep this up? So, in their latest annual shareholder report, they do describe what's called a 2026 North Star strategy. So I'm not going to go over the entire thing. The most important item from the North Star strategy was increased development of their JRNY platform, where they talk about how they're going to really update or increase the amount of R&D going into the platform. Additionally, one thing I really like that Jim Barr did was he finally sold the Octane Fitness brand in 2020, which was just being a massive sort of source of asset impairment charges throughout the years. Okay, so question still is this a turnaround story, or will Nautilus continue going back to declining revenues after COVID is done? So I think it's really important to see what analysts are thinking here. So quick side note about analysts. Analysts, when it comes to giving price forecasts, are absolutely terrible. I would not trust their price forecast whatsoever. I believe they're motivated from other sources. Also, I can't describe how to give their price forecast. I've heard sometimes they use technical indicators, or maybe some do, and I believe technical indicators are a terrible source of trying to predict. Actually, you cannot predict stock price from technical indicators. Generally, a stock price is random. You can't predict it, but you could kind of tell how an asset's value is doing compared to its historical numbers. But yeah, analysts not great for price forecasts, but they are great for giving revenue estimates and growth estimates, in my opinion. So you got to understand, analysts do get like, each analyst has only a handful of companies they're really studying. So in each company, they're spending hours in their day of researching the industry trends, seeing what management is doing, oftentimes even talking to management. So they usually are able to give pretty accurate estimates of revenue growth throughout the years. For example, at least whenever I get the Yahoo notification of how a company is done to its reports, you always see beat analyst ratings by 2 cents, or loss on analyst ratings from by 3 cents. So I understand this is cents per share, and when you multiply it by the number of shares outstanding, it's a bigger number. But overall, estimates for analysts for revenue are not bad. So analysts are saying that Nautilus can get a 2% year-over-year growth on their revenue from 2021 to 2022 and 2022 to 2023. So it's not a lot of growth, but it's massive improvements compared to when we saw revenue declining greatly in the 2018-2019 years. Additionally, analysts are predicting that EBITDA will be decreasing. Cannot find why they think that, but we will be using their decreased forecasted EBITDA numbers when we value Nautilus. So we're going to value Nautilus against its competitors and against what it's done in history. So first, let's take a look at Nautilus's competitors. These are fitness companies that I thought were most similar to Nautilus because they primarily sell home fitness equipment and they don't have other streams of revenue, like, for example, selling brand t-shirts or other things like that. So Technogym, Johnson Health Tech, and obviously Peloton. So Nautilus is the smallest here. It's 443 million dollar market cap versus all of these other companies having billion-dollar market caps. So let's start by looking at return on invested capital. When I look at all these numbers, I will only be looking at the latest 2020 numbers, just because I don't really, usually I like to look at the numbers like from 5 years ago and see the trend is going, but we already know Nautilus was a declining company, so there's no point in actually looking at how Nautilus was declining, just because we've already analyzed that. So these will only be including their latest 2020 numbers. So return on invested capital. Phil Town says return on invested capital is the most important ratio he looks at when analyzing a stock. It basically tells us how well is management doing with the capital we're giving them and the capital they're taking out as debt from banks. So formula: net income over debt plus shareholder equity. Technogym, 13.6%. Johnson's Health Tech, 5.5%. Peloton, 6.5%, which actually did surprise me a little. And Nautilus here has a massive return of 63.9%, which is absolutely ridiculous. Usually above 15% is very solid. 63.9% is massive. They're definitely not going to be able to keep this up, but it just does show that management has done a great job in allocating the capital we as shareholders are giving them. Next, net profit margins. How profitable is Nautilus, and how much money does it need to put into its products? Or basically, what ratio do they need to sell their products at in order to recover their capital? So Technogym, 7.1%, Johnson 3.3%, Peloton 6.5%, and again Nautilus beating at 13.2%. So these definitely are great margins from Nautilus. Next, it's always important to look at how a company's doing on debt compared to their EBITDA, or even compared to some other metric, but you always need to analyze the debt of the company. Everyone here is doing generally pretty well, besides Johnson Health Tech, who has a debt to EBITDA or net debt to EBITDA of 4.11. This is a little higher than I like it to be. I definitely want my net debt to EBITDA I require my net debt to EBITDA to be under 3 before investing in a company, just because that's the standard that a bank is willing to take out on debt for a company. So definitely not doing bad here. So how does this all fit into the valuation of Nautilus? So we're going to be using EBITDA here, and this graph only includes Technogym and Johnson's Health Tech, just because Peloton were incredibly overvalued or had an incredible valuation of above 100. So there's no point including that. So as we can see here, Nautilus is trading quite cheaply compared to its competitors here. 2.49 compared to 21.22 and 22.14. With analyst predictions of EBITDA at $85 million, their EBITDA is still at 4.15. So Nautilus is trading at quite a bit of a discount compared to its competitors here. Let's look at how Nautilus is trading compared to its historical EBITDA. So this graph will show you the historical EBITDA starting in March of 2015. So we have an average of around 6.10, which is even quite conservative in my opinion, just because of how greatly it was brought down due to severely negative EBITDA ratings in 2018 and 2019. So the average 6.10, current is 2.49, which shows that even compared to how they've been trading historically, they are still quite cheap on this metric as well. And even if we insert analysts' new estimates, we still get 4.15, which says quite a bit. I do believe we have a lot of room for upside in this stock. However, there are plenty of risk involved here. So, first of all, I generally do not like investing in turnaround companies just because I don't feel that management has been given enough time to show that this is a turnaround story. Jim Barr has only been there since July 2019, and I feel he needs more of a track record to really show that he could turn this company around. Here are the three other most important risks to keep in mind if you are going to invest in Nautilus. First of all, if the economy tumbles, Nautilus will absolutely plummet. Right now, the stock market is quite richly valued, in my opinion. And if for some reason we have an economic downturn, people are not buying exercise equipment. They're going to be saving their money, and EBITDA numbers and generally any numbers for Nautilus will completely plummet. Secondly, the second risk with Nautilus and this sector of the health fitness industry in general is there's a high reliance on supply chain. So this is a common trend I noticed when reading even Peloton's annual reports, is that both companies do have one manufacturer, or very few. In Nautilus cases, it is one manufacturer. In Peloton, they may have a few more, but very few manufacturers all the way in Asia. And it does take a couple of weeks for orders to come from Asia all the way to the United States. So analysts do have to have quite accurate predictions of how much supply they will need when telling their manufacturers what to make. So in COVID, basically what happened, for example, was they did not expect a high consumer demand, and there was quite a bit of a supply shortage. So luckily COVID was great for Nautilus because it did help their numbers. But on the opposite side, if analysts do overestimate how much equipment they need, and they do have over abundance of supply, they will be selling their equipment at lower dollar percentages, just because storing it in their warehouses in the United States, particularly in Oregon and Ohio, is quite expensive. And yeah, so those are basically the major risks I analyze with Nautilus. Overall, I do not know if I would take a position in a company. I'm not saying I would. I do have to give it further thought just because it's not exactly my investment style. I generally do like investing in what I see as stock compounders, which will grow their revenues greatly and do have a great track record of growing the revenues, who are generally trading at a discount due to some short-term market problems. So thank you for watching. If you liked the video, please leave a like. If you have any questions, please comment and subscribe.